Assalamu alaikum students and welcome back to new video. Earlier we have seen about terms of credit. So let's recall what we have learned. Interest rate, collateral and documents requirement and the mode of repayment together comprise what is called terms of credit. Let's take an example to understand terms of credit. Mega, one more case study, and case study is one of the easiest way to learn economics, right? Mega has taken loan of 5 lakh rupees from the bank to purchase house loan. The annual interest rate on the loan is 12% and the loan is to repay in 10 years and in monthly installments. She has to pay 10 years in installments, monthly installments. Mega had to submit to the bank documents showing her employment records and salary before the bank agreed to give her the loan, and some other documents like identity card, residence, those are the common. The bank retained as collateral the paper of new house. Collateral we have discussed before, right? Assets. So new house definitely will owned by her. So bank will not take her house, just documents of house keep as guarantee, collateral what we call. So which will be returned to her, to the Mega, when only she repays the entire amount of loan with interest. So in this case various conditions are there, we call them terms of credit. So here, which are terms of credit? I am going to give you terms of credit, answer you find by yourself. Alright, I am going to ask just mention terms of credit and what are the terms of credit in the case of Mega, you have to answer. Like loan amount in rupees, how much loan she has taken. Second, duration of loan, for how long time, that is also one of the terms. Third, documents required. Fourth, interest rate. Fifth, mode of repayment, how to repay. And the last one, sixth, collateral. Those are terms of credit. And terms of credit are different, may vary on the basis of nature of borrower and mainly lender. Right? So how? Because here terms are varied because of credit in different credit arrangement. People arrange credit from different sources. So let's try to understand that varieties in credit arrangements. And those varieties let's try to understand by the study of different case studies. So here are different case studies. First I am going to tell and along with it I will explain you. So let's begin with the first case study of a person named Shyamal. And who is Shyamal? Shyamal is a small farmer from one village, Sonu. Better off we take it as imaginary village, right? So let's discuss about this farmer's condition and from where he obtains his credit. Shyamal tells us that every season he needs loan for cultivation on his 1.5 acres of land. Small farmers owns 1.5 acres of land. Till few years back, he would borrow money from the village moneylenders at the interest rate of 5% per month interest rate. Generally we count interest rate annually, 12%, 20% per annum, that means per year. But here 5% per month, so 60% a year. 1 month you have to pay, means basically he has to pay 5% of his total amount. Total amount, that means here we count principal amount. So 60% a year, but generally as farmer he takes for few months. So Shyamal has been borrowing from an agricultural trader in the village at an interest rate of 3% per month. He takes from money lender 5%. Now from agriculture trader 3%. So basically beneficial to him. At the beginning the cropping season, the trader supplies the farm inputs as credit. In the definition of credit we have seen, right? Credit is like agreement between borrower and lender. In this agreement, lender supplies various goods, services or money with the promise of future repayment, right? So here that agriculture trader supplies him agriculture inputs like seeds, weedicides, pesticides, etc. Whatever inputs required, agriculture trader supplies to him, which is to be repaid. Now repaid in form of money, but when the crops are already harvested. Besides the interest rate, but here he provides credit as on cheaper rate. But besides the interest rate, in terms of credit, one more term is included. So, besides the interest charge on the loan, the trader also makes the farmer promise to sell the crop to him. This condition, one of the terms of credit, apart from interest rate, repayment, and other things. Here, those farmers have to sell their crops only to that agriculture trader. So, also since the crop prices are low after the harvest, the trader is able to make a profit from buying the crop at the low price from the farmers and then sell those crops when the prices rise. So here who earns much profit? That agricultural trader. So here this condition still bad for the lender, for small farmer, and profitable for the agricultural trader. Now one more case study of Arun. And who is Arun? Arun is supervising the work of one farm laborer. Those farm laborers are there, so there is a large farmer, so he supervises. That is his work. So Arun has 7 acres of land. He is a medium farmer, 7 acres of land. He is one of the few persons in Sonepur to receive bank loan for the cultivation. That earlier we have seen about Shyamal, a small farm, is not able to get loan from the bank because he is a small farmer, his income is not adequate and his land is not enough. So banks are not ready to give him loan. But here Arun is comparatively bigger farmer. He has enough land and adequate income. So banks are ready to give him loan. So he is one of the very few farmers who are able to obtain loan from the banks, from the village Son. So the interest rate on the loan is 8.5% per annum per year, compared to 60% from money lender. and 36% from agricultural trader. Banks charge only 8.5% per year. Definitely profitable, less expensive credit, right? More, and can be repaid anytime in the next year. One more benefit to the farmer: they can pay anytime in the next 3 years. If they pay earlier, then interest rates remain same, but amount of interest lesser, right? So that is also benefit to them. Arun plans to repay the loan after harvest by selling part of crop. He then intends to store the rest of the potatoes in a cold storage and apply for the fresh loan from the bank against the cold storage receipt. Here, first he used his land to obtain credit, and he has planned to repay that loan, right? So if crops successful, then he would harvest his crop and some part of potatoes, because he generally takes potatoes. So he has planned to sell some portion of his crops, potatoes, and rest of potatoes stored in cold storage. Why in cold storage? Because sometime during the harvesting time, prices fall down. So he wanted to wait when prices rise, right? So much profitable to him. And his plan to store the potato in cold storage and apply for the fresh loan for the coming year, and from the bank against the receipt of cold storage. And receipt of cold storage mentioned, right, how much potatoes that stored in the cold storage. So the bank offers this facility to farmers who have taken crop loan for them. So that is security for the bank as well as profitable for the farmers, because he is medium farmer, he has enough land, but this condition is not applicable for everyone, not available to everyone. Let's see one more case. Here two cases we have seen: one small farmer, one medium farmer, large farmer. Now third, a worker, laborer. So Rama is working in neighboring field. She works as an agricultural laborer, and conditions of agricultural laborer we know very well. So Rama has no work and needs credit to meet the daily expenses. For agricultural laborers, certain period of time every year when those people become jobless, no work. They try to find casual work but less opportunities. But they have to pay for their daily expenses such as food, medicines, etc. So those laborers generally take loans. They take loan from their masters. Masters, I am using word here, masters, their employer. So expenses on sudden illness or functions in the family are also made through the loan. Apart from daily expenses, sudden illness, family functions, social occasions, etc. For certain conditions, they take loan. Rama has to depend on her employer, a medium landowner in Sonpur, for credit. Banks definitely won't give them credit to the agricultural laborer because they are poor, they don't have collateral, they don't have assets, right? So they have to take loan from their employer. So the landowner charges an interest rate of 5% a month, 60% per annum. Rama repays the money by working for the landowners. Rama, she doesn't have any source of income, so she works for the landowners and repays. Right? Most of the time, Rama has to take fresh loan because working in the farms that does not give her adequate income to repay the loan and to meet her expenses. So at present, she owns the landowner rupees 5,000 she has to pay. She owns her landowner 5,000 rupees. For us, it's not a big amount, but for her, that's very huge amount to pay. The landowner doesn't treat her well because now she caught in debt trap. She continues to work for him since she get loan from him when she needs. Rama tell them to this conducted case. The only source of credit for the landless people in Sonpur are the landowners, those who are employers to them. Not only in Sonpur, but in whole India, in entire India, in the villages, there is no source for the landless laborer to obtain the loan. So they are entirely depend on their employer, most of them. Some of them take loan from the local money lenders. So here we have seen different sources of credit, different sources of loan. In first case, agriculture, trader and money lender. Two sources we have seen, agricultural, trader and the money lender. In second, banks. In the third one, employer. Now let's see one more case, loan from cooperatives. There is one more source need to be understood. Besides banks, the other major source of cheap credit in rural areas are cooperative societies, also known as cooperatives. So, cooperatives, organization on the basis of cooperation. Generally, such kind of organizations are established with the same type of people. Same type, I mean to say, with the same occupation, same profession. Like farmers cooperative society, as well as traders cooperative society, right? So those kind of cooperatives, and they provide cheaper loan. So members of cooperative pool their resources for cooperation in certain areas. There are several types of cooperatives possible, such as farmers cooperatives, weavers cooperatives, industrial workers cooperatives, teachers cooperatives, traders cooperatives, right? Those are cooperative society. So those people who belong to same profession, same occupation, they have their cooperative society. They join the society. So how do they do it? Let's see. Krishi cooperative function. One example here. Krishi cooperative function in village not very far away from Sonpur. It has 2,300 farmers, members. It accepts deposit from the members. Similar like banks, those farmers instead of banks, they deposit their surplus money to the cooperative society. With this deposit as collateral, the cooperative has obtained large loan from the bank. So this cooperative society uses those deposits for providing small loan to the members. If members require small loan, cooperative society provides them small loan at very cheaper interest rate. But if large amount of loan, cooperative is unable to give them. So this cooperative society takes loan from the bank. This deposit uses as collateral and takes loan from the bank and gives that credit to the needy members. So this fund are used to provide loan to the members. Once this loan are repaid, other round of lending takes place. Krishi cooperative provides loan. Why they provide loan? Mainly for purchase of agriculture implements like machines such as tractors, harvester, as well as for irrigation system. Loans for the cultivation and agricultural trade, fishery loan for the construction of house, and for the variety of other expenses they provide loan, and other members push the borrower to repay the loan on time. So this is how they share the responsibility and how they share the benefit in the cooperative method. So this is that is why this is known as cooperative society, basically known as cooperatives. So such cooperatives are important, especially for the various people such as farmers and traders. So here we have seen the different variety of credit arrangement, and this varieties of credit arrangement in the Indian economy divided into two sectors, formerly known as formal sector of credit and informal sectors of credit. So in next video we will discuss about formal sector of credit and informal sectors of credit, their advantages and disadvantages, right? So we'll discuss about sectors of credit in the next video. Stay tuned. Thanks so much.